welcome to our October Finance and Audit Committee discussion. I would like to call the meeting to order, and Amber, if you would conduct a roll call of members so we know who is present, please.
Sure. Thank you, Paul. Adrian Cochran.
Present.
Carol Dzinski.
Present.
Paul, you are here.
Present.
And Mike will be absent today, and we do not yet have Alex or John with us. We do not have a quorum yet.
Okay, so we do have a very robust agenda. We're going to try to move through it as best as we can. If we require votes and we attain a quorum later in the meeting, we'll probably circle back on any voting items. Our first item of business is to review the meeting minutes from September 24th. I know we can't take a vote on it since we don't have a quorum, but do any members have any revisions or edits to the minutes as they're presented? I do not.
And Paul, John will be joining us shortly.
Ah, great. All right, I haven't heard any other comments or edits regarding the minutes. Do we think John will be with us momentarily, or should we circle back to a vote on the minutes later on?
I think we can circle back for them.
Okay, very good. Then we'll move on to our next item of business, which is a presentation of the audited financial statements for the period ending June 30th, 2021. So I will turn it over to the folks from Markham for that discussion. Good morning and welcome.
Great, thank you. Good morning, everyone, and thank you for the opportunity this morning to present our presentation of the audit, which covers an 18-month period and really focuses on the balances as of June 30, 2021. And this morning, I'm pleased to be joined by Damon Kogel, who's the director here in the Hartford office, and I'm Chris Jackson, by way of introduction, the audit partner. So we'll walk you through a presentation. Feel free to ask us questions as we're going through this. It'll be interactive. There's a couple of discussion points here that we should definitely have as a committee, but certainly feel free to reach out to us, and our contact information is also in the end of the presentation, and I believe that we'll be sending out the presentation as well as a formal document after the meeting, so you will have everything, and feel free to reach out to Damien or I at any point if you have questions, not only now, but during the course of the next fiscal year as well. So we're here as a resource to the audit committee, and we do report to the committee. So I will ask Damien to share his screen if we can and walk you through the presentation. And Damien is far more qualified at doing this than I am. That's why he's going to share.
And Damon, you're all set up
Yes.
to share your screen.
Can everyone see my screen?
Yes.
Yes.
Yes. Can you make, there we go. Thank you.
There we go. Good job. All right. So thank you, Damien. This really is just an agenda listing of the items that we'd like to cover this morning. Certainly, we can answer any of the questions you may have. I was asked to try to keep our speaking presentation relatively brief, so we'll have time for plenty of time for questions and answers at the end, and have the whole component take basically 30 minutes. So certainly, we will try to get through this as quickly as possible. If we're going too quickly, just let me know, and I can certainly slow down and go at a slower pace. But that's the goal, is to be done within half an hour. So the first part we'd like to discuss really relates to the presentation of these financial statements and the classification of CTPLA as exactly as what you are recognized as within the state reporting structure. The state of Connecticut has classified the organization as a component unit, and we agree with that. So there's really no concerns as it relates to the classification of the entity as a component unit. We've got the definition here. This is lifted right out of the CAFR from the state of Connecticut from last year. And if you go through this criteria, you definitely would hit number one as far as control and by the appointment of the board of directors. So therefore, the financial accountability element exists. And I don't believe there's any question with the authority or us as to whether you're a component unit. That is how the state has classified you in their financial statements for GAAP reporting purposes. For budgetary purposes, they've got you classified as a fiduciary fund. And that's where you ended up last year. If you look at some of the budget reporting and the reviews that they had, you were basically classified as a fiduciary fund itself for that purposes. This year, we're looking at GASB 84, and that introduces the concept of a fiduciary component unit, where it's really taking both elements of the definition of a component unit and then looking at you whether you meet the criteria to be classified as a fiduciary and in fact, a fiduciary component unit. And this is an area that the Office of the Comptroller and Mark, we're still working through a couple points on this as far as their expectations of what will be reflected in the financial statements for next year. Is really the question whether, whether you have a statement of cash flow or do not have a statement of cash flow is really driven by the nature of the fiduciary fund. A fiduciary fund, in this case, a fiduciary component unit, would typically not have a statement of cash flows. They are requesting a statement of cash flow. So that we can certainly have more discussion about that. But on this slide, we really laid out the definition of a fiduciary component unit. And this is lifted right out of GASB 84. Not that I'm encouraging anyone to read GASB 84, but if you'd like to, you certainly can. We can make it available to everyone on this call if they'd like. Management has it, we've had it. This is lifted right from paragraph 8 of GASB 84. And it goes through and defines what a fiduciary component unit is. If you meet one of these 3 criteria, so it's not all 3, you only have to meet 1 to be considered a fiduciary component unit. And Markham's position is that you meet the first bullet there. That and again, I don't want to spend too much time reading it for you, but basically that the funds are administered in a trust. The government, the state of Connecticut, is not a beneficiary. The assets really are to be used to provide benefits to the participants who have made contributions, the employees of the state of Connecticut. And the assets themselves in the trust are protected from legal claims against the state of Connecticut. So again, we believe that the organization clearly meets that definition and would be considered a fiduciary component unit. The state, I think, or the Comptroller's Office, again, we have not spoken with them. We certainly can do that after this call to kind of button things up a little bit. I think we're just trying to go through and make sure that we're all on the same page as how you're classified, but we believe that you are a fiduciary component unit. We can certainly work to revise the draft financials or the financial statements that were provided to this committee to more strongly make that point that you're a fiduciary component unit, change some of the terminology in the accountant's report and also in the footnotes to make that point clearer if that's helpful. But I think the point of, I don't say point of contention, but just the state would like to see a statement of cash flow going forward. And they also would like to have some of the language removed as it relates to fiduciary is their recommendation. And we do believe that you are in fact a fiduciary. So let me pause for a second because I've said a lot here and certainly can let management chime in or we can have some open discussion about the description of how we see the organization compared to the elements of GASB 84 and the old terminology of fiduciary fund. So I'm not sure, Andrea, if you'd like to say a few words or if you'd like to open up for discussion.
No, Chris, I would just like to open up for discussion. I know we had extensive discussion yesterday. I got a very, very quick education about component units and fiduciary component units. I had to learn it in about 15 minutes, but I agree with the conclusion that you've come to. And we'll just continue to have conversations with the Office of the State Controller.
I'm not sure there are any questions from the committee. And again, the financial statements will not change. The numbers that you've seen in the financials that you have in front of you will not change. It's just how you're classified as far as the name, whether you're just a component unit or you're a fiduciary component unit. If we get rid of the language, which I don't believe is correct, that refers to you from fiduciary net position all through these financial statements, I believe you are, in fact, a fiduciary. And if that's the only points of real contention, the numbers are not going to change. And whether we can get a cash flow statement in here, that's another topic of discussion too, because GASB 84 basically says that the financial statements that will be issued by a fiduciary component unit include a statement of net position and a statement of changes in net position, period. They don't say including a cash flow statement. A cash flow statement's optional. There's line to a cash flow statement where if you were a different type of fund of the government, they do explicitly say you would have to have a cash flow statement. So it's precluded from the language. So certainly we could try to work within the framework. The textbook answer is that you should not have a cash flow statement under GASB 84. Therefore, one was not included in the financials that were issued. But we could certainly try to work through our national office and see if there's a way that we could, I don't say bend the rules, but accommodate the state's request to have a statement of cash flows in there. So that's kind of what we're working with right now.
This is Paul. So I have just a quick question. Based on your comment that there is a discussion ongoing with the State Controller's Office, and it may impact perhaps some labeling, maybe I'm oversimplifying, some labeling within the statements, and the possibility that you may have to provide an additional statement to the financial reports, the audited financial reports. You are otherwise complete with your work. But we could potentially expect something that would be revised that would reflect some wording changes to accommodate whatever the controller's concerns about rolling the authorities financial reports up to the state's comprehensive annual financial report. Is that correct?
That's a very good summary. Yes, the numbers will not change, which you have seen here. We're done with the audit. We've basically issued the audit and just working on the wording changes with the state controller's office. Yes, that's a very good summary. So I apologize for maybe going on a tangent here, but I just want everyone to be aware of what we're working with the state.
I just, I'm a simple man, so I like simple explanations. I just wanted to summarize it for myself. Thank you.
It's a great summary, and it's not contentious. We're working with the controller's office, and we'll get there. It's just we want to make sure that we're in conformity with the GASB guidance, but also that the agency is not adversarial, not objecting to what their requests are. Because again, we're all part of the state. We want to make the state satisfied and work together as a team. So it's not adversarial. It's just what can the GASB framework allow us to do versus what they're asking us to do. So that's really where we are.
Very good. Thank you.
All right, I'm going to have, now that we've had that discussion, I'm not sure if anyone else had comments. If not, I will have Damien go through the next few slides.
Thanks, Chris. So the next few slides will just take us through the areas of audit focus. This is a first-year audit, so we wanted to make sure that we touched a lot of the pieces that are reflected on your statement of fiduciary net position and your statement of changes. And the first piece and biggest piece is the contributions that were received from participants and your contributions receivable at the end of June 30, 2021. And these contributions they are a percentage of each employee's payroll deduction based on the employer electing to go into the program. At the end of June, there were approximately 2.5 million collected, or 1.5 million collected, and then subsequent collections, which we ran through August 31st of 2021, was an additional 99 million. We did not, or the authority did not, put an allowance on the books to reserve for any additional collections, just based on the fact that there is a 60-day window for everyone to submit their collections. And if you look at the contribution percentage, the receivable percentage as a total of contributions, it's right around 50%, which we would expect for 6 months of total collections, 3 months come in after, 3 of them falling in that after year-end receivable bucket. For these procedures, we primarily we selected a sample and we sent out confirmations to the employers. We got some responses back, and for instances where we did not receive responses, we worked with management to perform alternate procedures to ensure that we had good comfort over the balances. The next slide really just talks about the investments. So once the contributions come in, they are sent to they're remitted to the state treasurer's STIF fund. And the fund is administered by the state. And as of June 30, 2021, there was 1.1 million of those funds actually sitting in the investment fund. Once the 99 million came in after year end, those would also be remitted. But as of June 30, we saw 1.1 million of those funds being sitting in the state's investment fund. And we sent confirmations to the state just to ensure that the balances reflected on the statement of net position was accurate as reflected in the authority's financial records. The third item third and fourth item here that we considered to be areas of focus were related to the debt and the funds held by the state. As the authority became operational, they received funding from the state of 5.5 million in seed funds through the general fund. This 5.1 million will be paid back to the state of Connecticut. So we've captured that, or management captured that as part of their long-term liabilities due to the fact that it's required to be paid back no later than October 1st, 2022. We did confirm the balance with the state, and we also confirmed that there was approximately $923,000 still remaining that was unspent as of June 30, 2021. In addition to that 5.1 million, the state also, through the bond commission, allocated 12.2 million to the authority. And we can again confirmed with the state that of that 12.2 million, 4.4 was unspent as of June 30, 2021. And the full amount of 12.2 million is also sitting on the statement of net position, of fiduciary net position, as a liability back to the state of Connecticut. We confirmed both sets, and we felt that the balances were appropriately reflected on those on the financial statements. And we have included additional disclosures in the notes to the financial statements as it relates to all three that I just discussed. So it goes into the notes to the financial statements, does go into a lot more detail in terms of each of the items that were discussed earlier. Any questions on the previous 2 or 3 slides that I just went through? I'm going to, if not, I'm going to turn it over to Chris that's going to talk us through the pension and OPEB liabilities that were recorded on the financial statements.
Great, thank you, Damien. This is an area that we spent a tremendous amount of time getting our arms around, the pension and the OPEBs and the allocations as it relates to the authority being a startup entity. The allocation methodology used here really focuses on June 30, 2020 employees as the baseline for the allocation for 2021. And the actual projections are based off of a study basically that was done as of June 30, 2020, rolling it forward for a year and projecting. So there is some sense that there could be some volatility and fluctuations in this. You had 2 employees at June 30, 2020. You've got 16 employees or so on June 30th, 2021. The allocations were based on a much smaller population. Therefore, they are subject to change, and we are expecting to see an impact on your income statement and fringe benefit expense in 2022. So I'll briefly walk you through this as much as I can. You know, unfortunately, the footnotes here, you've got about 12 pages of footnotes in these financial statements and 4 supplemental schedules. So about 40% of your financial statements relate to pension and OPEB. So I do apologize for that. That's the GASB, but it's a huge number for the state of Connecticut. Your number is not as huge, but it is important as well. So we'll briefly go through this. If you look at the first table up there, it shows your pension liability that was allocated to the authority, and the deferred outflows are offsetting that liability. So the impact on your fiduciary net position is actually an increase of $160,000. And what that relates to, the majority of those deferred outflows relate to your contributions that were made. As I said earlier in the presentation, the actuarial liability was based on evaluation that was done on June 30, 2020. It doesn't take into account all of the contributions that were made in your fiscal year 2021. So you've got 12 months of contributions at a higher base of employees that were made into the plan. And that was, you know, that was really a big driver of that asset. You're basically saying the liability allocated to you on a June 30, 2020 basis is $320,000, but subsequent to that date, you made, you know, contributions. There are other variables going there, but just for simple sake, let's just say $480,000 of contributions during that time period, which reduces the liability. So you end up in actually, oversimplify and say it's an asset position, but you're actually a positive increase to your net position as a result of those contributions that you made in excess of the liability that was allocated to you. So it's a little unusual setup the way the governments are doing this is standards for GASB 68. So it's not unusual to the state of Connecticut, but it's basically a year in arrears allocation. With trying to catch up with a small startup organization, we expect there to be an impact to that number going forward, that you can have a larger piece of it because you basically had a reduction in fringe benefit expense as a result of your funding of the pension plan. And down below, we just show you a relative percentage, which is a very small percentage of the state's $23.7 billion liability. There is your fractional percentage of it, and your allocations were based on that allocation. So the next slide, we've got We talked about the OPEBs, similar situation. The liability for the authority is $373,000. Your outflows are $537,000, which is actually going to put you in asset position or positive position, and fiduciary net position of $163,000. So again, that's another pickup to your balance sheet as it relates to this. And the table below shows the state liability of $23.5 billion and your relative percentage that was allocated. There are evaluations that were performed by specialists, actuarial specialists, and that's what the overall total $23.5 billion was based on. And if we go to the next slide, this is showing the schedule that we based the allocations. We work with management to record the numbers that were reflected in the financial statements, the liabilities, the deferred outflows, the deferred inflows, some of the other elements. Those items listed there were allocated to the authority, and that allocation was actually audited by the auditors of public accounts, who issued an audit opinion that covered those schedules. So we pulled the allocations off schedules that were audited by others. We tested the inputs to those schedules. And basically, we are in agreement with the state of Connecticut as it relates to the amount that they say was allocated to the organization. So if we go to the next slide, this is where we see that the contributions for last year were only $36,000, and that's what the liability was based on. This year, your contributions for both the OPEBs and the pension were $678,000. So again, a sizable increase. We're expecting that to have a sizable impact on the allocation next year. So we do have a couple of paragraphs in note 1 that describe the uncertainty as it relates to the fact that you're a startup organization, and we're expecting this to increase going forward with the increased number of employees. And just the overall big picture takeaway of this is, after you flow through all of your contributions that you made that would have hit fringe benefit expense, all of the actuarial allocations and the liability allocations to the organization, the authority had a pickup, which basically reduced your fringe benefits that were reflected in these financial statements of around $300,000 this year. So if you looked at your fringes where you were through the course of the year, after booking all these entries, you actually had a pickup of $300,000, because they're basically saying this liability was based on a smaller population, and you made contributions in excess of that liability during the course of the year. So that could flip next year. But overall, if you're looking at your year-to-date financials that were presented to this committee before these allocations were recorded, your net income is going to be $300,000 higher as a result of this. And this is really just record keeping, and it's going to come back most likely next year with increased fringe benefit expense. So I said a lot there, but it's a very important topic. It distorts your fringe benefit numbers based on expectations, and it's a very judgmental process as well. So next year will be interesting to see the allocations that are made to the authority and what impact that has on your financials. So again, I said a lot. I'm not sure there are any questions on that topic. As I apologize, I'm running out of time. I promise to make it up in the next few slides. But that was important to cover, I thought. And one of the most important areas, that and the whole component unit discussion, were really the main points of our focus during the audit, in addition to the other areas. So the next slide, well, if there's no questions, I'm going to try to go through these in like 2 minutes or less and get you back for some questions. So the next section really is components that are required communications. They're required by the AICPA auditing standards. We're required to cover these with the committee. We don't have to go through a lot of detail, but we'll try to go through these as quickly as possible. The first slide really just focuses on fraud. It's a required slide, so don't panic, but we are required to discuss fraud, and these are the procedures that we performed at the middle of that page. We did focus on that. We had discussions with management. We're not aware of any fraud or illegal acts. I am not sure if any members of this committee have any concerns related to fraud or illegal acts, or aware of any, but if they do, certainly just feel free to let me know. And we can consider that when we go through the wrap up and actually the issuance of the final report in next year's report. But again, we don't expect there to be any issues based on our initial discussions, dialogue, reading of the minutes, and everything else. The organization has good controls, good segregation of duties. So that really, the segregation duties really was focused on by Andrea with her review, and they were compensating controls, and everything's really in play at the end of the year. So again, we had no issue as it relates to fraud.
Just like to add a point on the fraud. Responsible for the unemployment insurance program of the Department of Labor across the country, and you've heard me speak before on this, there was significant imposter claims filed on our unemployment programs throughout the country, billions of dollars. So just want to offer caution. You don't know what to expect in all cases. You have a very sound principle here, and I'm very confident. But my point in just offering guidance is that we have to be prepared and aware for the circumstances that are around in our state and around the country and what we're seeing. And I know that individuals on the team are aware. I just want to offer the caution on the imposter claims and the fact that the PII of everybody is available to the criminals, and not just in our country. This is a worldwide problem. And again, I think the processes here are much different, but just to be vigilant on the circumstances that are coming our way.
I think I do appreciate that, and that's something we'll definitely look out for next year when you start going through the controls over the benefit payment process and focus on those. And again, it's hard to catch the fraudsters, but certainly if you're aware and think of the schemes that they're perpetrating throughout the rest of the country, it's certainly helpful to consider that. So thank you for that point. Okay. Next, we've really just got some more required communications. Just talks about the elements that are included in the financials, and these will be provided to you after the meeting. So certainly if you have questions, let me know. I'm just trying to get back on track of it. About a minute left. So I apologize for that. And then just really, no material unrecorded adjustments to the financial statements. Everything is in line with expectations. So the financial statements agree to our opinion, no disagreements as it relates to financial statement amounts. It was really a collaborative effort to ensure that the authority recorded all the liabilities to converting from cash to accrual basis. So again, it was a collaborative effort to make sure you had all the liabilities in the books, including the pension. So again, we don't consider those to be audit adjustments. They're really closing adjustments that we facilitated with management, and management took full responsibility for all of the proposed entries that we had, the amounts that we came up with. No difficulties during the audit, really, a great collaborative effort. We learned to focus and improve communication skills during the course of the audit as we worked together for the first time for the year, and that was really on us. So we certainly worked with management to again, we believe, deliver a good audit, and next year will be much smoother, I think, once we've got the communication protocols worked out. And, Andrea, Dave, and Locke, and Amy, and the whole team were delightful to work with, and it really was a smooth audit from that standpoint. So again, good audit overall, no issues as it relates to independence. And I'm not sure there are any other slides, Damien, if that's the last required communication slide. That was it. Good. So I finished at 9:30, so I apologize for not leaving enough time for questions at the end. Certainly, if management will permit, I'm certainly happy to answer any questions you may have.
Certainly. If the committee has any questions, we want to hear them and have them answered.
All right, it sounds like there are not any questions. Thank you very much, Damien, Christopher. Pleased that the audit for the first 18 months of operations is solid. So
it is. We've got a good team, and we really enjoyed working with Andrea. Is the pillar here. It's nice to work with Andrea and keeping everyone focused on controls. And she's got a good team below her in finance too. So it really was a good effort. And it's nice to see that with a new organization to be that solid and pulled together. And again, we're looking forward to next year's audit, and continuing to work with the comptroller's office to exactly make sure that we're meeting their expectations as well as conforming to the government auditing standards and GASB rules as well. So thank you for your time this morning and the opportunity to work with the organization.
Thank you.
Thank you.
thank you very much. Appreciate it. I note that John Scott has joined us. If you'll permit me to circle back to item 2 on the agenda, which is to review and approve the minutes of our September 24th meeting. Now that we have a quorum, we can consider whether there are any amendments to the minutes, and if not, to review and approve those minutes by vote of the committee. So I think I'd asked before whether anyone had any revisions to make. I don't know, John, if you had any comments, revisions, edits. Hearing none. Thank you. Is there a second?
Daryl, second.
All right, it's been moved and seconded. All in favor?
Aye.
Aye. Anyone opposed? Abstentions? All right, the minutes have been adopted. Thank you very much. So that moves us to item 4 on the agenda, which is a presentation of the findings of our updated actuarial analysis. And the folks who had conducted that actuarial analysis are on with us. So I will turn it over to them to walk us through the materials. Thank you.
Good morning, Mr. Chairman and members of the Finance and Audit Committee. My name is Michael Vorgetz with Wild Fig Partners. I'm leading the presentation on behalf of our project team. Jeffrey Hayes of the Institute for Women's Policy Research conducted the benefit utilization analysis included in this presentation, and Jeff is here today. Will participate as needed. And our project manager, Rebecca Pena, is also in attendance. On slide 2, we have an overview of the presentation. Since last year, we've learned quite a bit about the actual effects of the pandemic on FMLI programs around the country, claim volumes, collections, and other variables. So I'll begin by reviewing updates to the 2020 forecast. Importantly, the current forecast includes 2 benefit utilization scenarios: anticipated, expected activity, and high utilization, that is more claims and higher payouts than expected. For each scenario, we offer an alternative forecast if benefit rates are adjusted from what is in current law. This was done to be thorough and for informational purposes, not because such action was expected to be necessary. We know you're on the edge of your seats about the findings, so we'll get to an executive summary on the next slide for some key takeaways. The key takeaway really is that the forecast is positive. The trust fund remains solvent in each scenario that we ran over the 5-year period. Revenues exceeded expenditures over the time horizon of the forecast. And there is time to wait and see actual outcomes and trends based on program activity and other developments that may occur outside of the program. Moving on to slide 4, we'll get in a little more detail about the updates since the 2020 forecast. We were able to analyze a lot of important data and trends over the last year, especially related to claims activity in other states and the labor market. The authority also has more precise administrative costs information. The current analysis more directly addresses the impact of the state's minimum wage increase on costs and revenue collections. This analysis also includes detailed benefit utilization scenarios for anticipated and higher than anticipated claims activity. And we want to note that the Washington State experience during their program's recent launch is the basis for the anticipated utilization scenario, obviously with adjustments made for the differences between those, the state of Washington and Connecticut. And then recent experience in legacy states, California and Rhode Island, is the basis for the high utilization scenario. Recent experience is very important, and it includes the effects of the pandemic in those states. We generated sub-scenarios, if you will, with adjusted benefit rates, which I'll address in a later slide. And the table on the right of this slide summarizes the updates and their effects. Slide 5 compares total claims filed under our 2 scenarios for the program's first year of benefit payments. The chart on the left shows the breakdown of the expected 83,900 anticipated scenario claims. And then there are about 10,300 more claims expected in the high utilization scenario. These totals account for what is expected to be about a 7.4% uptick in year 1 claims. This is based on Washington State's year 1 experience. This is a one-time phenomenon. Year 2 total claims are expected to be lower than the year 1 total. And as I mentioned before, Jeff Hayes of IWPR is here to address any questions around this or other subjects of the report. On slide 6, we're getting into detail related to the anticipated utilization scenario and forecast. It shows the fund's projected fiscal activity with anticipated utilization, On the next slide, we'll see high utilization. The same revenue forecast was used in both scenarios. Actualized revenues to the fund are forecasted to total $425.5 million in calendar year 2021, increasing to $570 million by 2025, which is a cumulative annual growth rate of about 7.5%. Projected growth in revenues is predicated on a gradual decline in unemployment over the 5 years, as well as wage growth assumptions provided by Connecticut's Office of Policy and Management. On this slide, we see expenditures exceeding revenues in 2022 and 2023. This is due to the first year benefit costs being higher and implementation spending, but revenues are projected to exceed spending by 2025. In this scenario, the trust fund balance decreases initially, but stabilizes and grows by the end of the forecast period. Moving on to slide 7, we have the high utilization forecast. As I mentioned earlier, the anticipated utilization scenario is based on Washington State. The high utilization is based on California and Rhode Island experience. Both include, the activity during the pandemic. And the key difference on this slide compared to the last one is significantly higher benefit costs, which drive total expenditures higher than revenues in all years. Accordingly, investment income to the fund will be lower, and the year-over-year decline in the fund balance will result. Nevertheless, there are some positive takeaways here. One is that this is not a picture of insolvency. The ending balance in 2025 is still projected to exceed $150 million. And a second is that revenue growth is faster than expenditure growth. Looking at the right side of the slide, the graph shows revenues closing in on spending by 2025. Still, the year-over-year decrease in the fund's ending balance warrants close attention and may prompt contingency planning down the road. It would be recommended. The following slide offers some insight into how this can be addressed in the future if necessary. So this slide will review the benefit adjustment analysis that was conducted. Both scenarios are presented with current law benefit rates as well as benefit rates adjusted lower by incremental and full step. The current law benefit formula, as you all know, specifies wage replacement at 95% of wages up to a certain threshold, and then 60% beyond that, up to a minimum wage cap, a cap that's 60 times the minimum wage. And then the incremental and full step down, as you can see with the numbers on the slide, are stepping down those percentages. So when we start here in the end of 2021, the balance in both scenarios will be the same because benefits are not being paid out in 2021. Claim activity in 2022 results in a dip in the fund balance with current statutory rates in place. The solid line that you're seeing is what was presented in the earlier slides. The dotted line shows balances in the fund if benefit rates are adjusted. The high utilization scenario plays out similarly, but the decrease in the fund balance is protracted with current statutory rates in place over the 5 years. Still, both pictures show a fund that can withstand the unexpected and is likely to be stable, if not growing, by the end of the 5-year period. If it's higher than expected utilization, and if that does in fact lead to a declining balance, there are mechanisms that can be put into place. It is important to emphasize that this forecast allows the state, in our view, the luxury of time to see how the trends develop. And if actual experience leads to undesirable trends, planning may begin, say in 2022 or 2023 to make adjustments. Our final slide recaps the key takeaways and repeats the bulleted listed items in the executive summary. And I want to thank the committee for the opportunity to present today. And I also want to thank Andrea and her team for the opportunity to engage with the authority on this important project. And with that, I'm happy to answer any questions.
This is Paul. I'll start by saying thank you very much for having a very digestible presentation. I think that the graphs are very helpful in understanding at a glance the projections that you've put together. So I don't have any particular questions, but I wanted to thank you for making the potentially difficult world of actuarial forecasting so understandable to a lay reader. Thank you.
Thank you. I wouldn't describe you as a lay reader, but yeah.
I'm not an actuary, so.
I work in the insurance business, and the actuarial science has always befuddling me. Can you go back to one of the first slides? Just want to wrap my head around this one. Well, yeah, no, I'm sorry, the second one, then with the actual numbers. So if I'm reading this correctly, so in 2022, when we start paying benefits, we're going to have a balance at the end of December of 2022 of $360 million.
Yes, that's what we're projecting.
So every December 31st from 2022 to 2025, we're going to have a closing balance of $350 million, give or take a million or two.
Yes, roughly.
So, and that scenario doesn't change even in so that's anticipated utilization. So even if we go to the next screen over, which is the high utilization, we'll finish the year with still well over $100 million, even in the worst year there. It looks $155 million in 2025. Makes me wonder if we shouldn't lower the percentage we're taking out of people's paychecks. It seems irresponsible for us, unless I'm reading this wrong, it seems irresponsible for us to be collecting and holding on to this much taxpayer money. Am I reading that wrong?
Well, no, you're reading it correctly. I mean, certainly adjusting the tax rate is, is a matter of for you all to consider when you feel it's appropriate to do so. And I would offer, though, that we don't, just in the same way that we are recommending waiting and seeing how things play out, there is quite a different picture between these two scenarios. If you have a year-over-year declining fund balance, it may be premature to consider lowering the rates, given that you may have to make the opposite kind of adjustment later. The other factor here is that there is the 1 year period of collections. So when you are, as you all know, you're starting the fund and you have collections, but you're not paying benefits. That is, by design to build a balance that would withstand, a potentially uncertain future, as all futures are. So I would say that, while we believe strongly that this is a positive picture, I think there's still reason to be cautious about making those kinds of changes. But we'd certainly be happy to provide more detail into the effects of that if that was requested by the committee or the authority.
So I guess my second question, I know from insurance companies, if we were a traditional insurance company like the Travelers, the Hartford, or something like that, we would have to have a certain amount of cash in the bank in order to get our ratings and things along those lines. Is there a standard yet developed for an operation like ours across the country that identifies that the closing balance should be within a certain window or something along those lines?
I wouldn't say that there is a single standard. Based on my understanding of the various state laws, they tend to differ from state to state to some degree, but the principles are pretty similar. They're looking back over that prior year at administrative costs, at fund balances at different periods of time, and conducting calculations that in some states are just set in law that trigger a change up or down in tax rates. I know that this is something that can be handled differently from state to state, but it is also a key distinction when you have a legacy state that's been in operation for a long time. You tend to get a more consistent year-over-year activity, and you're able to project based off of historical trends. That's not something that unfortunately that we have here because it's a new program. But I think it is a very important question, and there are some good examples from other states as how that is handled.
Michael, if I could just add something. So John, we asked the exact same question, but just anecdotally talking to Massachusetts and Washington, they felt comfortable if their fund reserve was somewhere in the neighborhood of 75% of benefits and administrative costs. That's just what they use as a ballpark. It's not written down anywhere. It's not codified in statute, because their programs are relatively new too. But what's different is they have additional forms of revenue, either through employer and employee contribution, plus money from the general fund, depending on their respective general funds, depending on what their sources of revenue are. And we have just the one, which is the contributions from employees. So we have a bit more volatility and vulnerability that other funds don't have, because the assumptions built in here, Michael, please correct me if I'm wrong, right, assume that there is a steady increase and improvement in the employment market, so that the contributions that we have projected here are ones that we can count on as we think employment rates will rise and wages will rise with them. But if there's another change in that, then we have a vulnerability in that spot, which is why we were tending to forecast more conservatively using the high utilization rate, and that the gap that you see in 2025, we're especially in this scenario where we're drawing down in order to cover benefits, it can be concerning, which is the word that Michael used. So what I would say to the board right now is to just wait and let's see what happens before we move in one direction or another. And I think the labor chairs also have a specific position as well that we would have to consider before making any change in one direction or another.
I guess we'll have to wait and see on this whole thing. It just bothers me that, and Andrea, we've talked about this before, that $20 out of someone's paycheck could be the difference of food on the table type of a thing. And here we are sitting in a worst case scenario on $155 million that's not being spent. And that bothers me.
I understand, John, but the other side of it is, I also don't want to take that $20 from someone and then go back to them and say that the fund is insolvent. And I know we're not looking at a scenario of insolvency at all. So I think as the board continues to consider both sides of that coin, we'll just have to be very prudent in the choices that we make. And there might be a compromise that we strike, which is that it doesn't go down precipitously, but maybe it goes down from 0.5 to 0.4. Some states have, I can tell you, some private employers are, they're offering their employee contribution at 4.75, just a bit below, right, as an incentive to go into the private plan. So we have some options that I think will allow us to provide some relief if that's what the board chooses to do, and still help to shore up the fund's long-term fiscal health.
Actually, that presents another question then. So if we've got people that are rating private plans just under our income level, if playing the game of insurance company here, if we offered it at 3.75 or 4, so we're a little bit less than the private market, would we have more income making up the difference in the lost revenue?
Well, and that's an interesting question. And although we have, relatively speaking, a high number of employers that are in private plans, many of them are quite small. I mean, the average employer that's in a private plan has 15 or fewer employees. So even though you may get more that might participate, we'd have to look at what the aggregate number of the aggregate amount of revenue that would come in as from that group. If some percentage, and I guess you could work on what those increments might be, would come into the plan. But for those employers that might be considering it one way or the other, it might be an incentive to them. But they're also the incentives that the private market is offering. It's not just a lower contribution rate. Some of them are not asking for any contribution at all, but they're also bundling the offering with other benefits that they're already giving them. So they're using different ways to, from their perspective, that makes it easier for their employees to participate. And we've just been supporting them in that and just waiting to see what happens. But so far, it hasn't had any adverse impact on the fund's solvency. Because I know one of the concerns was we would have sort of a rush to private plans, and there's been a good balance, and that has proven to be true also in Washington State.
I just want to add, this is a definite, very interesting concept and discussion. I just think that the projections are projections, estimates, like stats and whatnot. So my suggestion is to wait and see on the operations, and then we would have some factual data to look at along with the actuary and going forward. So I think it's a wait and see, and a very interesting points. It's good. It's great to see the non-high utilization. And again, to John's point, I think we'll be having more and more discussions with factual data.
John, the other thing we want to consider is that federal paid leave is on the horizon. And we really don't have any idea what impact that's going to have on our model that we've created as a state. We would be considered under the proposed federal statute to be a legacy state, but it also may mean that we would have to make some adjustments to the way that our program is structured, and we just don't know what that means yet. And so, for that reason alone, right now, I think it's important for us to wait and then see what comes to pass. And then I think we can make a holistic and more informed decision about what to do about our state plan and the federal plan as it affects it.
If I could,
I'm not insisting that we make a change now. I guess my point in this conversation is remember, this is a tax coming out of people's paycheck.
Oh, yes.
People can voluntarily buy car insurance or whatever, but they're being forced to pay this.
Yep.
So I think we have to be cognizant of how much money we have in the bank, because that's not fair to the taxpayers.
We agree.
I was going to offer, if I could, that what's clear from both the presentation and from the points that John has raised is that there are two policy levers available to the board. One is on the benefit side, and the other is on the I'll call it the contribution side. Both of which would have to be informed by forecasts about future activity, economic, payroll growth, et cetera. And in my experience with forecasting, while trend analysis isn't always the best model upon which to forecast the future, we don't have any past experience that would guide us in making a change to either policy lever. So my opinion is that we ought to get some experience under our belts before we pull either lever, lest we pull a lever and then shortly thereafter have to veer in the other direction. But I very much appreciate the points that John raised. They're very valid. The points that are presented here around different scenarios about benefit levels are important for us to consider, and we begin to offer benefits very soon. So that actual experience we'll have to keep tabs on it, and I'm sure we'll be having more of these discussions both at the Finance and Audit Committee as well as the full board as we gain that experience. Were there other questions for our friends from WildFig, Michael, or the rest of the team? All right, hearing none, I guess that moves us to the next item on our agenda, which is to review our budget position. And for that, I will turn it over to Locke to walk us through whatever documents he has prepared for that discussion. Locke?
All right. Good morning, everybody. And before I start, I wanted to thank the two teams from Markham, IWPR, and WildFig for putting together the presentations today. They both overcame some challenges due to being a new authority or a new agency, but overall, it was a positive experience for all of us. So thank you for that. Wanted to share my screen and start with the September financials for comparing budget to actual. Total expenses are just under 880,000, where the majority comes from payroll at 303,000, which is a little less than the previous month. Andrea Comer had moved on, and that's what details. That's what the reason for the little slight decline. Our staff is increased by 5, so we anticipate that growing in the next coming months. 328,000 was spent out of bond funds for the contribution system build by Slalom, and we continue to pay our monthly United Way contact center expenditure of 120,000. 75,000 was spent on outreach and engagement as we ramp up for our benefits launch. A third of these expenditures were placed on our Authorities Bank of America credit card, and due to a processing error on their side, the account experienced a small credit card fee, which will be reimbursed in a future month. Moving on to the cumulative budget and compared to actual, we still have 878,000 left in our seed funds and 10 million in our bond funds. At the bottom line, we'll see that we are 15 million better than budget. And again, the majority of that is from unused bond funds, which we anticipate using through the year. With our bond fund schedule, you'll see the 328,000 spent to Slalom here in 2 expenditures. Again, this is for the contribution system build. What you'll see on this slide is 450,000 upcoming towards DOL. There's a statutory requirement to have an MOU in place with DOL to have them administer our appeals process. In order to administer this process at DOL, we are splitting the cost of that build of 900,000 down the middle, and this 450 is putting it down on our books that we are sending half of it their way. For the contributions, for the month ended 9/30, we have 190 million. Currently, as of 10/20, October 20th, we have $214,575,986 either received or in transit. We expect to receive the lion's share of third quarter contributions at the end of this month. And lastly, on this slide, I wanted to point out that this number here, the fiscal year 2022 budget, does recognize the $20 million increase to the budget for the impressed accounts that we plan on having sending over to AFLAC in December. And with the last slide, the cumulative contributions budget to actual, we expect by year end that we'll have 400 million for a revenue of payroll contributions in total. What's yet to be seen is what the benefits will look like as thoroughly discussed by our actuaries in a previous presentation. So far, the expenditures are straightforward. You can see that our quarterly admin fee is on target, as well as our monthly repayment to seed. With that, that concludes my presentation of the financials. Does anybody have any questions?
Locke, you said that the projection is that by the end of December, there will be $400 million in contributions that will have been collected.
It's after 4 quarters. 4 quarters of contributions would bring out, would expect 400 million by the end of January 1st.
By the end of January, okay. So as the quarter that concludes December 31st would be received in January, right? So we would have $400 million at that point in time.
That's correct, Paul.
And that coincides with the balances that were presented in the actuarial report that we just reviewed.
Correct.
I just wanted to, in my own mind, confirm that there is an alignment in that assumption. So thank you.
There is that 30-day grace period is kind of what throws things off. So I think when the concept of building up the fund in the calendar year was developed, no one really anticipated that there would be an extra month essentially for the 30-day grace period, because that hadn't been determined at the time. But I know Locke and Walter and Dave, they can all tell you that all the money, like virtually, 99% of it comes in the very last day of the month. Like sometimes at 11 o'clock at night, it comes in at the very last moment. So it's just more responsible for us to count it that way, because that's what we've been experiencing. And that's what other states told us they were experiencing. And it's true.
Does anyone have any additional questions? All right, thank you, everybody.
All right, thank you, Locke. Appreciate that. That brings us to items of old business. Is there any old business that anyone would like to raise? No old business. How about new business? Andrea, you're listed on the agenda. Did you have any new business you wanted to bring up?
I think Amber just, puts me on there in case I do, but I do not have any new business today. No.
All right, excellent. And if there's
Really, if you don't mind, Paul, I really did want to thank our actuaries and our auditors because they really did do exceptional work, and it can't be easy with a startup, and we were supported so heartily by the Department of Administrative Services, and I really want to thank them too, and OPM and everybody that really helped us get going, because now you can see that we are a little bit more mature than we were 18 months ago. We still have more work to do, but we're just very grateful to everyone that helped us to stand up the authority so that we can be where we are today.
Let me add my thanks both to the audit team as well as to the actuarial folks for the hard work they've done, and also to the staff at the authority. Andrea, you have a great team, and they've done a lot of excellent work, and I appreciate that. I know the members of the committee appreciate that. If there is no additional old or new business, that moves us to the adjournment item on our agenda. Is there a motion to adjourn?
Motion from Daryl.
All right, moved.
Second.
Moved and seconded. All right, thank you very much. All in favor?
Aye.
Aye. Opposed? Abstentions? Wonderful. Thank you all so much, and I will talk to you all again next time. Bye-bye.